Good afternoon, everyone, and welcome once again to our CIBC PMA Summit Series. This has been an enormous success, and we're just delighted to have you here with us again this afternoon. Chris Markovic, my president, will give you a good, strong thank you to all our sponsors, but I just want to particularly point out CIBC, who's been just a tremendous supporter all the way along and makes many of these broadcasts so possible and so strong. You've got a fabulous panel today, just two today. So we've got a little more time to kind of explore some of the issues and elements of the day, particularly regarding the economy and finance. And Chris will introduce Benjamin Tall from CIBC and Kiki Sauriol-Roode from Genworth Capital, who will be two of our just a fabulous speakers we've got. Let me warm this up a little bit in our traditional fashion, going, wow, another record. So here we are 3 months in a row, July, August, September, of record sales. September topped 11,000 resales, quite remarkable in the GTA, and it's still going with steam. The sales up, 42% from a year ago. You heard those headlines Monday and Tuesday of this week. Just an amazing story. Despite the COVID calamity of April, May, June, actual resales for the GTA are actually ahead of last year now. So not only have we recovered, but we've surged ahead, and you're in for a great year as it finishes up. As you know, prices are up 14% year over year on all product. They hit a new world record in Toronto on average price in September. Phenomenal. Active listings are up, which is probably a good thing. Hopefully that brings some balance, but it's got to go a ways yet. We're sitting around 18,000 units of resale listings. Needs to go to 25, 27,000 to bring a market to balance between buyer and seller. And so it's on its way, but it's, the sales have been so powerful, it's chipping away at new listing supply as it comes in. The big surge in listing, and I'm sure this will get talked about a little bit through the session today, has been in condos, resale condos. Probably the market hit hardest, as that's predominantly renters. That is predominantly the area hit hard by COVID. And those renters are now coming out of those units. The investor who bought those units having a hard time to rent them. You've seen resale listing supply double to now over 40% of total listings at 7,500, nearly 8,000 units. That's a remarkable number. That's a number we've not seen before. And this is a trend line to watch very carefully in the coming months. It's affecting the resale market, not the new market particularly. So I'll just comment on that for just a second. What's happened is this surge in low-rise sales. 50% of the sales detached in resale in the month, 160% increase in low-rise sales in new housing around the market over the year. Just unbelievable shift or spike back in demand, a V-shaped curve, whatever you want to call it. It's been quite remarkable in these last few months. The area that's the watchword or the area of most concern, probably driven to a great degree by immigration, of which, of course, we have none, is resale condo. And that's where entry-level buyer had gone to. That's where the immigrant had gone to rent. So rental rates are coming down. Prices have been flat for 3 months in a row, whereas you've seen low-rise prices soaring. And that's been happening both in suburban 905 and 416. There's been some great stories in the month. Goodness gracious, I chuckled, but how much fun was Bradley Homes in Barrie with a drive-through in your car to a tent, people lined up in their cars overnight for a townhouse release, and then did as a social distancing in their car, and they moved quite a few units overnight, starting at 8 o'clock in the morning the next morning. So the kind of a reflection of this movement of urban to suburban has been very, very powerful. Metropia and Pickering, oh my goodness, 100 sales over the weekend, another 100 in York Downs, all townhouses or back-to-backs, quite remarkable. Ballymore in Keswick, of all places, 60 deals done on virtual. Most of all this, 75 to 80% is all being done virtually. Addy out in Burlington. I can pinpoint many, many projects. And then we've got this hot spot of high-rise in Mississauga. Brightwater, Canopy by Liberty, Daniels Corp, all hovering around 1,000 a foot. The investor saying, I'm 4 to 5 years down the road. I'm not concerned about COVID today. It's the current inventory of resale condo that's going to shift this market, make it a little uncertain over the next 6 to probably 9 months until immigration starts to return. New supply continues to be as tight as a drum, and is getting tighter. Low rise is actually down in supply month over month into September, and continuing tighter. Whatever's being released is being scooped up dramatically. Little pushback on price at the moment. Lumber's up dramatically, steel's up dramatically, drywall's up dramatically. Often driven, but that's all driven by the U.S. market and how strong it is. But price push has been remarkable, and the consumer's pushing back a little. So we're feeling that right now. It's a little softer now going into middle to late October and into November. And we expect the low-rise market to be fairly stable over the next several months, not as frothy as it has been. And high-rise is going to be related to very special projects like a Brightwater or this central Mississauga that's been so strong. You're going to have to find, I think there's maybe a little bit of price pressure on the condo market, just to be a little more careful with my pricing, not as aggressive, so a little more self-regulating. The overall story, quite remarkable. Continuing, absolutely. Low rates driving it, psychology driving it. I'm going to make a change in my life after COVID coop up. I'm going to go somewhere else and change my life. Oh, work from home. Oh my goodness. Even my daughter, who works in a major corporation right downtown, one with a competing bank of CIBC, signed off on her work from home papers and spent a month and a half in Collingwood, for goodness sake. Now talking about moving from the Danforth to Collingwood. How remarkable. That's the story. That's where we're at. It's all good news. Should continue, we think, at least in a more stable fashion going forward. Just watch the condo scene. It's got some bumps on the road. Over to you, Chris. That's my warm up. And over to you, Chris Markovic, for intro of our speakers. Thank you so much. Great being with you again. To you, Chris.
Thanks a lot, Andy. My name is Chris Markovic, and welcome everyone in the audience to another edition of our CIBC PMA Summit Series. Today, I want to express our thanks to all of our sponsors, including Next Home, Build, Aurea, Westmount Protect, Reliance, and Buzz Home. And very importantly, our title sponsor, CIBC. I've said it before, CIBC has been a wonderful partner throughout from the very beginning of our programming, and we're just thrilled to have you continue on to support us through this initiative. So thank you to CIBC. When we kicked off this series back in the late springtime, Ben Tal gave us the keynote for the kickoff, and I'm thrilled to say that we brought Ben back. Benjamin is a published expert in all things commerce, real estate, credit markets, and business. Benjamin Tal is the managing director and deputy chief economist of CIBC World Markets, Inc. He's advised industry leaders, clients, corporate boards, trade associations, and governments for nearly 20 years, offering his expertise on financial and economic matters. Welcome, Ben.
Thank you very much. I will share my screen to show you some nice pictures. And let me just make sure that you can see it. 1 second. Shoot, I lost it. 1 second. Give me a second, okay? Okay, I hope you can see. Oh, shoot. 1 second, okay? Can you see it?
Yes.
Good, okay, sorry about that. So I will be relatively brief, and we'll see what makes sense and what doesn't, given this situation, which of course we haven't seen before. I will start with talking a bit about the virus, clearly how the economy is responding, government programs, a little bit about housing, and see what makes sense given this environment. Of course, you cannot talk about the economy without talking about the virus. So let me say a few things about what we see regarding the trajectory of the virus, talking to many people in the field. There are basically three models now. One is the continuation of the first wave or way into the second wave. That will be the US and most emerging markets. The second model, if you wish, is the beginning of a second wave, and that's Canada and most of Europe. And the third one, which is the most interesting one, is the end of the second wave, and that's basically places like Australia or Japan. Now, if you look at this chart, you can see why the US is so different. This is really a situation in which for a given rate of infection, the US, at any point in time, since the beginning of the crisis, the US was much more open. So if you are a Trump supporter, you will point to the fact that economically speaking, the US is outpacing many countries because the economy was open. Of course, the negative spin is that the infection rate was much higher. And clearly, history does repeat itself. The chart to the left is 1918 Spanish flu. And you can see there were basically three waves. You can look at the chart to the right, that's the US now. It's starting to look very similar. And I think that that's the direction we are going. The third model, which is the most interesting one, Japan, Australia, to an extent South Korea, is teaching us that you can bring the virus to its knees without totally shutting down the economy. You can see that the second wave is coming to an end in Australia, Japan, without really seeing the mobility index going back to what it was in March or April. This means that there is a way to achieve it if you do it in a smart way. Now, obviously, there is one important issue, and that's the fear factor. We know that when people are a bit concerned about the virus, the fear factor dominates the availability factor. Namely, you can open up whatever you want, as much as you want. People will not show up. And that's exactly what we have seen in March, April, and even May. Some US states were open, some were closed. Economic activity in the open states and the closed states were basically the same because the fear factor was dominating. During the happy days of the summer, the sun was shining, the birds were singing, and we have seen a situation in which the fear factor was going down and the availability factor was going up. And I suspect that over the next 6 months, the fear factor will start dominating again with the second wave and clearly the darker days of winter, as we all know we should expect. So that's the direction we are going. The honeymoon of the summer is over. The next 3 to 6 months will be more challenging when it comes to economic growth. If you look at the trajectory of the economy, that's exactly what we are forecasting at this point. We are at the negative 40% in the second quarter annual rate. We have never seen anything like that. In the third quarter, the summer, it was up by 40, 45%. So negative 40, positive 40. And then for the rest, the next 6 months, it will be 2, 3% if we are lucky. So that's basically where we are, clearly slowing down after the very significant recovery in the third quarter. But even if you get a 40% increase in the third quarter, you're not closing the gap because the positive improvement is, of course, starting from a low base. So negative 40 and positive 40 is not actually zero, given the 40% starting from a low base. This means that we are still 4.7% below the level we have seen before the crisis in terms of economic activity. 4.7%. Just to put things in perspective, during the financial crisis, during the recession back then, from peak to bottom, the economy was down by 4.5%. So what I'm telling you here is that we are now recovering, I repeat, recovering to the darkest day of the mother of all recession. This is the theme that I've been discussing in the past, the recessionary recovery theme. We see it also in the labor market. The unemployment rate before the crisis was 5.5. It went to 14%. Now it's on its way to stabilizing at about 8%. The move from 5 to 8 is a move that you see usually in a recession. And of course, the recovery is not a normal recovery, and the distribution is abnormal. Early in the crisis, we were debating what kind of a recovery will it be? Will it be a V-shaped recovery? Will it be an L-shaped recovery? Of course, we got both. 2/3 of the economy are in a full swing V-shaped recovery. Real estate is clearly one of them, the pioneer of the V-shaped recovery, if you wish, while 1/3 still stuck in this L-shaped recovery. This means that if those industries, and those are the usual suspects, tourism, personal services, transportation, restaurants, we know the story. If they were not able to fully recover or even start to recover during the happy days of the summer, surely they will not be able to recover during the winter, the second wave, the flu season coinciding with the virus. We know the story. That's why government policy here is extremely, extremely important. And I will not get too much into it because you know what's happening. The Bank of Canada is clearly doing whatever they can. The governor of the Bank of Canada gave us a speech today, basically saying, I'm here to support. Interest rates will remain low at this level until 2023 at the minimum, and if needed, they will do more. Inflation is not really a big issue now because there is no velocity of money. There is no huge increase in the rate at which money is exchanging hands. So you can print money without seeing inflation, at least in the short term, and that's exactly what the Bank of Canada is doing. The Bank of Canada is now controlling 1/3 of the Canadian bond market. By April, at this rate, it will be 50%. That's not a good situation. And the Bank of Canada would like to reduce the level of activity in the bond market. They will have to find a way to do it and start spending less and buying less bonds, because now they're buying $5 billion a week. That will have to go down in order to avoid a situation in which you basically dominate the bond market as we see in Japan. So that's the direction we are going, but interest rates will remain low, which means that fiscal policy will be very important. And as you know, the first reaction by the government was CERB, the $2,000 per month, as you all know, and of course, wage subsidies. It was very important, it helped. However, it was also a situation in which a lot of money, quite frankly, was wasted. Not on purpose, but when you design a program that should take 5 years to design in 5 minutes, clearly it will have a lot of holes. And that's exactly what we have seen. I'll give you just one example. Look at this chart. This is amazing. Just look at it. This is the number of unemployed people. However, this is the number of unemployed people that were not in the labor force in the month before. Namely, in order to be unemployed, you have to participate in the labor market. You have to actually physically looking for employment. If you are not looking, you are out of the labor market. Now, this is the number of unemployed people that a month before that were not even bothering looking for employment. They were not part of the labor market. And 66% of them were students. So all of a sudden, there is this huge increase, 500,000, one half of the increase in the number of unemployed people in Canada during this period. 50% of them are basically telling us, listen, I'm interested in the labor market. I'm entering the labor market. Why? And the answer probably is because there is CERB money. If I'm looking for employment, I might get the CERB money. To me, that's not optimal, because we must, when it comes to government spending, we must distinguish between a 17-year-old student that is not happy with his or her allowances and a 45-year-old parent of two that is unemployed. We must make sure that the money that is spent is going in the right direction. And the change in the SERB into the modified EI and the CRB is a move in the right direction. We must make sure that only the L economy is getting the support, because we simply cannot afford spending money we don't have. The debt level is high. We can manage it because we have seen a situation in which the starting point for Canada was very, very good. Interest rates are very low, which means that interest payments on the debt are actually going down. But it doesn't mean that you can just spend without even knowing where this money is going. So that's the focus. More directed, more focused spending, focusing on people who need it as opposed to everybody else. That's just a policy issue. Very, very quickly, let me say something about the housing market. Absolutely right. We are in a V-shaped recovery here, as you all know, and you know the numbers, so I will not really spend any time on that. Now, relative to long-term average, if you do the average since the beginning of the year, we are still not there in terms of overall sales, but we are getting there. At this rate, in 2 or 3 months, we'll be there. But of course, you cannot compare, and you shouldn't compare the current situation to a long-term average. There is nothing normal or long-term average about the current situation. We are in the deepest recession we have seen in the post-war era. You cannot compare it to normal times. There is nothing normal here. So let's compare it to any other recession. And compared to any other recession, this is the decline in residential sales per 1% drop in GDP. You can see a huge decline in 91, a significant decline in 2008, basically nothing today. So this is very, very different than any other recession. And the question is why? And the narrative is cheap money. Interest rates are so low. But you know what? I'm not so convinced. Because back then in 2008, when the damage was more significant, they did not have stress tests. And by the way, back then they had 30-year amortization. Today, yes, the actual rate is lower. But for both variable and fixed, for a business, as you all know, you have to qualify it at what? 479. You go back in history and you look at what kind of rates we have seen in 2008, they were actually lower. So we are qualifying people at a higher rate in 2000 than in 2008, but the overall level of activity is actually higher, which means that it's not just interest rates. It's much more than interest rates. The question is why? And the answer, I believe, is the composition of the pain or the abnormal distribution of the labor market pain that we have seen. Look at this. In every other recession, about 50% of job loss were low quality or low wage, and another 50% high wage, high quality. Today, because of the very specific nature of the market or the crisis, 80% of job loss today were in low wage occupations. Those people are mostly renters, as we all know, and that's why the rental market is struggling, in addition to the immigration story. So potential home buyers or homeowners that will want to go to move up, they haven't seen their income going down. In fact, it's going up. That was the opportunity that they've been waiting for, because interest rates are relatively low compared to where they were a year or 2 years ago. And they can. So you have a larger segment of the Canadian household space that is able to take advantage of low interest rates. That's a difference. That's a difference between now and previous recessions. Very, very important. And if you look at this chart, we learned something that you probably know, that if you look at the 18% year-over-year increase in prices overall in Canada, 50% of the increase, one half of the increase in this inflation is due to what we call the compositional factor, namely more activity in the higher end of the market. Higher end means detached, more expensive. So this move from less expensive to more expensive is, and therefore larger, is 50% of the increase in prices if you compare the HPI and the simple average. Now, let's go deeper for 2 minutes and see the composition of the increase in prices by price level. I'm interested to see where we see more inflation, in the lower end of the market or the higher end of the market. Let's take a look. The chart to the left is Toronto, the two red ones, and this is condo. So focus on the red ones first. The yellow one is Vancouver. Focus on Toronto. The left one is the condo space, the right one is detached. And you look at the distribution. Decile 1 is the cheapest, decile 10 is the more expensive, yeah? And you can see that it's basically even more inflation in the middle of the market. Namely, the more expensive condos are going for less price appreciation than the middle. So that's something interesting. Much more interesting is that in the detached segment of the market, you see inflation rising faster at the more expensive segment of the market, which means that people are moving up because they need more space. Just as a footnote, look at Vancouver, and there is a negative correlation between level and price acceleration. Why? I think in the condo space and clearly in the detached segment of the market, namely the more expensive segment is down. Why? I think the lack of foreign investment in Vancouver is much more significant in terms of impacting the trajectory of the market than Toronto, as we all know. And I think that Vancouver is a more service-oriented city, so you have more people feeling the pain in the labor market. So that's the story. So overall, just to sum up, I suggest interest rates will remain low for a long period of time. The huge increase in activity is not just because of, or just because of low interest rates. It's because of the composition of the labor market activity at this point, mostly low wage workers losing their jobs. The rental market will continue to feel the pain. I think that the lack of immigration is exaggerated. I will not get into it. If we have time during the question and answer period, we'll discuss it. But I think that clearly the rental market is suffering. I totally agree that the condo space is going to soften because we have a bit too much supply relative to demand, while the lack of supply in the low rise will be a major factor keeping prices more or less where they are. I agree that we are starting to feel price resistance entering the space, and that's something that will limit inflation. So overall, I think that the next 6 months we'll see the market softening, with some of this softness will felt more in the condo space. I will stop here.
Thanks, Mr. Tal. I actually have jotted down a few questions, but I think I'm going to save them right to the end. So let's introduce Kiki Sauriol-Roode. In her role, Kiki is responsible for managing key national lender relationships while supporting real estate in the building community. She provides insights and strategies to help grow the business, reduce cost, and originate high-quality loans beyond the mortgage insurance transaction. Kiki's joining us today to share the outcome and the results of the Genworth Homebuyer Fitness Survey study that was first performed in February of 2020. But in response to the pandemic, you went out, and I understand you reissued and had another look back in May. And today we're going to get a high-level look at those results and some of the sentiments. And just to really get a sense as to where today's home buyers' head is at. So welcome, Kiki. Thank you for joining us.
Thank you so much. Certainly appreciate it. I'm going to share my screen as well. Let's see how it goes. Can you see?
Yep.
Yes, we
can. Perfect. So Chris, you're absolutely right. I'm going to spend some time talking about a financial fitness survey that we did in conjunction with Environics, who did it on our behalf. And we were in market in late February and early March, asking Canadians how they were feeling generally about home ownership, some future intentions, as well as how they were feeling about their overall financial health. And then the pandemic hit. And it didn't make a lot of sense to tell a very rosy picture without checking in again to see how sentiment had changed. So we really view this as a pre and a mid-COVID finding. And the reality is we're still kind of mid-COVID. We definitely, had a rebound as economies opened in the summer. That's already been talked about. And we're seeing case counts rise now, and certainly, the months to come will be a challenge as things begin to retract a little bit. So the mid-COVID view, I think, is still relevant. Let me just advance my screen. It was advancing before. Here we go. The first thing we did is ask just generally about the state of home ownership of the folks that we surveyed. And we're not going to spend a lot of time on this slide because it's not dissimilar to what we've seen in a variety of others. And that is that about 2/3 of Canadians own their home, whether it's with a mortgage or that lucky crowd that doesn't have a mortgage on their home. About 1/4 of folks are renters. There's been some talk about renters already, and you'll see through some of the data that we've got here, it's validated that they certainly have been the most impacted from an economic perspective here in COVID. And then we've got a small segment that live without rent. And I've got one of those in my basement right now in first-year university. So we know that segment is alive and well. Generally, though, in this survey, folks that own their home had a stronger sense of financial fitness than renters did. And in this survey, you're going to see a little bit of a February view, and then we updated in May. Generally, we asked particularly future first-time home buyers, future intenders, what their interest in joining the market in the next 12 or 24 months was. In February, about 17% of them thought they were going to enter the market with relative quickness. Interestingly, in May, when we went back and asked, that number increased. And don't forget, that was, at a time when unemployment was extraordinarily high, when lockdowns were significant. What it tells us really is that the folks that were intending to purchase a home were already in good financial a place. They were already preparing for home ownership, and they really see the value in building equity in real estate. Interestingly, the millennial group and those new to Canada who didn't already own a home, they overrepresented general population here in terms of their interest in joining the market in the next 24 months. Then we asked people that already owned their property what their future repurchase intention was. In February, about 16% of them thought that they would enter in the next 24 months or so. That number remained relatively flat. Folks were comfortable already in the home that they were in and thought they might take a more conservative approach and wait to enter the market a little later to see what happened through the pandemic. Interestingly, first-time buyers were showing a little more interest. 26% of them over the general population said, I'm going to get back in the market in the next 24 months. So that's a lot of young folks looking to move up relatively quickly as their family dynamics change. We then asked how they're going to pay for their mortgage. And of course, I think most on the phone would know that Genworth is a mortgage default insurer, which means that we're in the low down payment space. Anybody buying with less than 20% of a down payment requires mortgage insurance. And in February, about 38% of the folks that we asked intended to buy with less than 20% of a down payment. Certainly more of them in the suburbs, more in Quebec, we're going to buy with a low down payment, millennials and newcomers to Canada. A lot of that makes sense because those might be the folks that perhaps haven't yet increased some of their equity, either with a purchase of a property prior or they're earlier in their career. Quebec stands out because more so than anywhere else in Canada, they actually tend to be renters more so than homeowners. More of those we're going to buy with a low down payment. But look what happened in May. That number that we're going to buy with a low down payment jumped to 47% of future intenders. That certainly good news from a Genworth perspective, but I think what it shows is that while people were confident in their financial circumstances, they were going to take a more conservative approach when they purchased their home. So they might, some of the equity that they'd been saving for a down payment, maybe they were going to put a little less down so that they had some cash in reserve to get them through what might be uncertain circumstances in the months to come. Don't forget, in May, we didn't know a lot about the pandemic. There was a lot of talk about a second wave being worse than the first. So this in some ways isn't surprising necessarily. One of the things that I will sort of highlight here is that typically folks in urban environments tend to put more of a down payment down. And in some ways that's counterintuitive because it's in the GTA, in Vancouver, where affordability is more stretched. You'd think those people would be putting less of a down payment down. But as it turns out, Bank of Mom and Dad tends to be alive and well in those markets, and gifting of down payments is stronger in urban areas. Then we turned really to this financial fitness metric, and it was created in 2011 in partnership with the Canadian Association of Credit Counselors. And it's not quite like consumer confidence, but it's asking people a series of questions that really helps to get to the heart of how do you feel about your own personal financial circumstances. And here's what happened. So when they started in 2011, the benchmark was set at 100. And other than a blip in the first year in 2012, and don't forget we were coming out of some challenging times then, it really has grown over time. And pre-COVID, going into that environment, financial fitness levels were as high as they've ever been since it's been measured for about a decade. So what happened in May? Well, not surprising, it fell a little bit. But it didn't fall dramatically. And again, I think it speaks to the confidence in homeownership and the confidence of the folks that were looking to get into the market. They'd already been readying themselves. But we did a little bit of a deeper dive, and we tried to understand where were the declines the steepest between February and May. And there was a steep decline with those working part-time, and Ben's already covered it off. Certainly from an income disruption perspective, those jobs that were most impacted were part-time workers. And so it stands to reason that they would, feel less confident in their financial circumstance in May. Newcomers to Canada, they're very optimistic about home ownership. They were in May feeling nervous and concerned about their circumstance. Albertans, certainly a steep decline as well, and that's not surprising given we've seen more economic challenge in that particular market given oil price impact as well. The thing that's interesting, and we spent a bit of time thinking about it, was baby boomers and Gen Xers and those making more than $150,000 a year, they were more than the general population concerned about a dip in their financial well-being. And I think a lot of that comes down to these folks had a bit more equity earned over their lifetime and were more heavily invested in the stock market. And of course, in May, there were bumps along the road. So we think that in part is what attributed to those groups feeling a steeper decline in their financial well-being. Given that there's a lot of folks on this call that are in the GTA and Ontario, took a little bit of a dive at that particular segment as well. Those folks feeling pretty confident still about their financial well-being going into COVID. They overrepresented in terms of feeling good about their financial fitness at 103.5% in Ontario and even higher in the 905 market. All of this sounds like good news, and it certainly is. However, make no mistake that in May, there was sort of a doubling of this group of people who felt like their financial circumstance had gotten worse. That was overrepresented in May in the Albertan group for the same reason that we just talked about. But again, the optimism and readiness for home ownership in that first-time buyer and future intender group comes out in this again, because that particular group actually felt like their financial circumstance had improved by May. And again, it speaks to some of that economic and employment impact, because if you hadn't lost your job, you might actually find yourself in a better financial circumstance because we weren't shopping as much. We weren't going out to restaurants in May as much. Certainly we were putting that travel off. So there was more savings that was happening with some segments. And that really brings us to some of the employment impact. And what we did ask was, what was the impact on your employment situation with COVID? The good news is that a full 2/3 of the population said that they had no impact or minimal impact. And a lot of those folks were people who were already homeowners. But it's not to take away from the full third of Canadians who said that they absolutely had a serious or very serious impact on their income. Those were folks who were in part-time service-related employment type jobs, those that for one reason or another were ineligible for CERB, and new Canadians said that they were more seriously impacted as well. Those in Atlantic Canada were less likely to say they were impacted, but if we then look at the deferral picture, the last bullet that you see, Atlantic Canadians were less likely to be impacted on an employment front, but they were more likely to have taken a mortgage deferral. Definitely speaks to a conservative attitude and approach. So in May, when we asked this question, 11% of people had applied for a mortgage deferral at that point, with a full 20% saying they might apply. I can tell you what we saw in our portfolio, and we were extraordinarily pleased with how all three mortgage insurers in this country came together to collaborate, as well as with lender partners, to put a 6-month deferral program in place to help mortgage holders get through this pandemic period. We saw kind of in May at the peak of things, about 18% deferral rate was taken. That dropped when we did our Q2 earnings call in the summer. By the end of June, we saw that deferral rate come down just under 14%. And I can tell you it's come down significantly more since. We're waiting on some reporting data. The 6-month deferral ended at the end of September. We fully expect that to come down even further. What I do want to make sure is clear though, and I don't know if a question will come of it, but thought I would capture it here. Even though the 6-month deferral program has ended, mortgage insurers and lenders are still very committed to those borrowers that still need support. We're going to work with them on a one-off basis, and if they need a little more of a deferral, we're going to provide that. If it appears as though there's good likelihood they're going to have a return to an employment scenario. So any of those borrowers that are still impacted, there will be a variety of options available still to assist through this pandemic. And then the last question that I'll cover really is about our last question to the surveys. And it was, how quickly are you going to get back in the market when things open up? And a full third of people said they're going to get back right away or within the first 3 months. And certainly June, particularly July and August, September, we saw that come to fruition. We've already talked about the fact that that housing has performed extraordinarily well through this, and we're expecting to continue to see maybe not as deeply strong a next few months, but absolutely continued activity in the housing space, which is a real positive for our industry and for the folks on the phone. If you want some of these details, we've got an infographic on our website, genworth.ca, that you can go to that really provides a high-level snapshot of a lot of what I've talked about. And I'm going to leave you with this. Something new is coming. This webinar is well-timed in that it'll probably be the last time that I'm going to deliver a Genworth presentation. We're in the middle of a name change, and on Tuesday, just after Thanksgiving, we will go public with a new branding, new logo. Still go to genworth.ca. It'll get you there, but you'll see who we are going forward. So we're awfully excited about it. With that, I'm going to turn it back to
Kiki. We're starting to see a lot of questions come in through the line, which is great. But before we get to that, I've got a couple of housekeeping items. Please stay on to the end for our now famous lunch draw courtesy of CIBC, where we draw 2 names for a courtesy lunch, as well as I'd also like to thank some of our new sponsors who have come onto the program, and that is My Design Studio, Balcony Bliss, and Smart Touch CRM. So please continue to send your questions in. And the first one that's come in is actually for Ben. Ben, you know, we've heard and you've referenced the recoveries. So what about the K recovery? What does and the question is, what does the recovery timeline look like for those that are on the downward trajectory of the K? And what can we realistically expect to be their back to green plan?
Yes, that's a good question. And unfortunately, it's not good news. I think that, as I said, 2/3 of the economy already in a full swing V-shaped recovery. It's the L segment of the market, which is 1/3 of the economy in terms of industrial output, and about 40% in terms of employment situation, means that if they were not able to recover during the summer, they will not recover, unfortunately, over the next 6 months as the overall economy will slow down. And again, those are very clear and predictable industries: hospitality, food, art, transportation, air aviation. We know the story. And this will not recover. In fact, the situation will get a bit worse, unfortunately, over the next 6 months. This means that the overall help when it comes to government policy has to be much more targeted, because at this point, everybody was getting money if you needed it or you didn't need it. I think that will have to change, and we have to be more specific when it comes to government support. But unfortunately, that will take a while. I don't see the economy as a whole reaching pre-recession level until 2022, and that's assuming some sort of a vaccine by mid 2021. So we still have some time in this asymmetrical economic growth, unfortunately.
It's a really good segue into a question that I had that I was thinking of as you were speaking, and it's the putting the money back in the hands of Canadians like the CERB, and now the revised plans that are coming. We've seen what the government programs were, and the commercial rent relief programs, and I think we can all agree that was with some limited success. What other measures that you think could be used to offset this impact and drive benefit where it's really needed most?
Yes, I think that the focus should be basically where you need it. So I think that the CRB that is replacing CERB is a good thing, focusing on self-employed, and then the modified EI system is actually a good thing. What was missing, as you suggested, was an effective commercial rent program. So far, it was about $1.8 billion. Let's face it, Trudeau is spending this for lunch, given how much money we are spending. This is peanuts, given what we need. Now, why it was not there? Because landlords did not apply. Now, why is it so important? Because everything is connected. The wage subsidy program is grossly underutilized. The question is why? First of all, it came late. Second is, if you're a small business, you have fixed income, you have rent, and you don't have the money to pay, you don't even bother with wage subsidies, you close shop. So I suggest that a rental assistance program is a precondition for a successful wage subsidy program. And as we know, the budget now for the wage subsidy program is $82 billion. The government is trying to shift people from EI, from CRB to wage subsidy. I say in order to do so, you must have a very effective rental solution for small businesses. And the finance minister just told us that they're going to replace the program with a program that will focus on the tenant as opposed to the landlord. I think that's the right way to go.
A question that's come up as you were speaking from Martin out in the audience. Ben, can you speak to how all of this money printing and debt will affect the Canadian economy?
Yes, the way it works is the following. The government is issuing debt, and the Bank of Canada is buying this debt and removing it from the market to keep interest rates low. That's basically what they're doing vis-a-vis printing money. what we call quantitative easing. First of all, there are two issues here. One is the credibility of the central bank, the Fed and the Bank of Canada, and the other is inflation. The credibility, of course, is an issue because in Economics 101, you know that the independence of the central bank is key to everything. And now, let's face it, the Fed, the Bank of Canada, they are not independent. They are basically government agencies. They are working for the government by buying all those bonds. Now, this is not a criticism. We have no choice. We have to do so, but that's a reality. So they have to labor. They will have to labor very, very hard to regain that credibility. That's number one. Number two, the issue is inflation. Because again, if you print money, are you going to get inflation? And the short answer is not in the short term, because in order to see inflation, you need the velocity of money, the rate at which money is exchanging hands rising. It is not rising. Therefore, inflation is not an issue. So from a short-term perspective, we don't see inflation, and the government can really support and finance this debt because interest payments are going down. And under any scenario, I don't see, with the exception of a no vaccine scenario, I don't see a situation in which the debt to GDP ratio will rise. In fact, it will fall. However, beyond the next 1, 2, 3 years, I think that we need to look at ways to make sure that the fiscal deficit is under control and the debt to GDP ratio is going down dramatically because the level is too high. That means that we'll have to cut spending, we'll have to be much more efficient in government spending, and we'll have to make sure that there are some increase in taxation that don't really kill the economy. And I think that's the direction we're going.
Thanks, Ben. We're going to switch gears, and I've got a question coming in for Kiki. Kiki, and Ben, you may actually have some commentary on this after as well, but CMHC did not have such a robust outlook on the market and pulling back. So Kiki, what's Genworth's opinion and outlook on this? And since CMHC altered their approval requirements, are you seeing an increase in submissions?
Yeah, so maybe I'll take the last part first. And you're right. I think everyone is aware that as of July 1st, CMHC made the decision to change their policies that limited the number of loans that they were prepared to support. It wasn't a regulated requirement. And so we took a real hard look at our portfolio and how it performs. And we were very comfortable with our risk approach, and we made the decision to not change any of our policies. And it most certainly did result in a significant increase in volume, particularly because all lenders in the country as well made the decision that they felt that with appropriate diligence from an underwriting perspective, that if folks were employed, it still made good sense to offer homeownership and mortgages. And so we are seeing some of that volume. We know that there will be a change in leadership at CMHC at the end of the year. So, certainly we're not sure what will happen from a policy perspective going forward, but for the short term, that has changed. In terms of their outlook on the market, our outlook is different, without question. Our employment outlook is pretty similar to some of the things that Ben talked about. We certainly see 7.5% to 8% unemployment for 2021, perhaps a little higher, maybe ending the year at 9 or 10%. A lot of the employment regrowth, if you will, has already happened. It's in those sectors that will continue to be challenged in that L recovery. It'll be harder for those jobs to come back, we think. And so we're feeling better than our major competitor is. Also, on a house price appreciation or depreciation perspective, there's not a lot of consensus across the market, in fairness. We've seen folks like CMHC predict between 9 and 18% house price depreciation into next year. And as high, some banks thinking it could be 3 to 5% increase in appreciation. We're somewhere in the middle. We think it's likely to be flat, maybe a point or two higher in certain markets going into next year.
Okay. This is more with speaking to your portfolio, Kiki, but do you have an indication as to the percentage of your insured approvals in the new home sales space versus resale, maybe even on, and if you've drilled down condo versus single family detached?
Yeah, sure. So I would say 20, maybe 25%, depending on the market, is in the new construction space. So the majority of what we see from an insured perspective is resale. But if you look at what we are insuring, I would probably say it's somewhere in the range of about 13% of the portfolio is in high-rise condo, versus about 66% is detached. And then the balance would be semi-detached and a form of row housing. Don't forget, with Genworth, we're really at the lower end of the market because we're that first-time buyer or move-up buyer traditionally. Also, from a regulatory perspective, we can't insure anything over $1 million. So we definitely see, a lower end of the market, if you will.
So with that, and regionally then, where do you see large percentages of your business coming from? I guess we'll speak within Ontario and the GTA. Is it the core? Is it Halton region, Niagara?
So it's not the core. In part, it's because from an affordability perspective, you got a lot over $1 million in the core, which we just can't insure. But as well, we're just seeing more gifting of down payments happen in areas where affordability is really stretched, which happens to be the core. So a lot of what we see is in the 905 region, even further out, obviously, Ottawa, London, Guelph, all of the other areas of the province, pretty meaningful regular distribution, if you will.
Okay. Questions come in. It's for both. And this is a fun one. After considering all of the factors, and I'm sure everybody was up watching last night, what do you feel the outlook is on our economy based on the outcome of the election?
Yeah, so first of all, when it comes to the elections, nobody, of course, can predict. It's very interesting. There are three alternatives, three options. One is Biden, the other is Trump, and the third is actually nobody. Basically, no clear victory, which to me is a nightmare scenario, and it's very possible that it will happen. I'll give you some examples. Only 10% of Trump supporters are telling you that they will vote by mail, which means that they will go directly and vote physically. 50% of Biden supporters are telling us that they will vote by mail, which means that the votes for Biden will come later. And you will have a situation in which the early results might actually show a victory for Trump because of the fact that you haven't actually counted the mail ballots. So I think that can lead to some chaotic situation. Beyond that, I think that both scenarios probably will lead to some improvement in Biden or Trump, improvement in the market, because Biden now is talking about spending before taxing, while of course Trump is talking about cutting taxes, so that's positive for the market. So I think that there will be a short-term rally regardless of who wins, but then we have to remember that under Trump, you will have really hard language going after China, and that can actually have some negative impact on the market and the cycle of the market. I'm talking about the stock market now. Overall, I think that the dependency of Canada on the US will rise, not fall, because regardless who wins, the trade war with China will be there because both the Democrats and the Republicans don't believe that China is playing fair. Under Trump, it will be much more chaotic and volatile. When it comes to energy, clearly negative under Biden, environment positive under Biden. So there will be significant differences between the two of them with some major implications for Canada.
Thank you.
I think Ben really covered, a good majority of it and can speak, much more articulately to the economic pieces than I can. Anecdotally, from a real estate perspective, we're hearing that certainly after the debate a week or so ago, there's an increase in people in the US looking for real estate in Canada. The reality is, I think there will be some uncertainty in the markets if Trump, as he has indicated, might not necessarily commit to a peaceful transfer of power. But, it could be short-term once, after a short period of time, things ultimately get sorted out. But when you've got a pandemic in play and a US election, there's certainly a lot of uncertainty that's ahead of us in the short term.
I'm being pinged by our producer here. So I'm going to bring it home with you, Kiki, but then I'm going to go back to you, Ben, and talk about best in class and best practices. So 2 questions for you. The first is, do you think the likelihood of millennials to buy a home within 24 months of their responses was decreased because their income was affected or because their confidence in the market had eroded? And the second part is, do you think that millennials who are actually considering buying in the near future will maybe, bank of mom and dad, basement apartment, maybe stay home or continue to rent? Have those numbers fluctuated in the last couple of months?
When we asked folks in May, we certainly saw that the millennial group continued to be overrepresented in terms of optimism and confidence about returning to the market than the general population. So that would suggest that group is feeling good about their home ownership prospects. And if they weren't in part-time roles, and a lot of home ownership folks are not, then if their incomes weren't interrupted before, they're still feeling really good about entering the market. Will some of them choose to continue to stay at home and save more money? That's absolutely a possibility. Will they lean on the bank of mom and dad? That's been a trend that has been happening for the last 10 years or so. So it's highly likely that that may very well play into things as well.
Okay. Here's an interesting one. If you were a bit of crystal ball, but if you were to redo the test today, what would we be overly more or less financially fit than in May?
No crystal ball here, but I mean, what I would say is that for those that hadn't lost their jobs already, they're probably feeling still pretty good about things, and likely maybe in a better financial position than they were before, because spending on things like entertainment and travel had been reduced. Those that said they were seriously impacted, they likely would say they were even more seriously impacted if we asked them today. And to some of Ben's comments, those are the kind of segments of the economy that are not likely to recover soon going into the winter months. And so almost a growing disparity perhaps between those groups that were feeling good and those that were not.
Thanks, Kiki. Final question, Ben. You're aware and have access and are seeing various different approaches on a global, I would imagine globally. Are you seeing surprises and innovation here in Canada right now or abroad? So what's best in class today for recovery?
Yes, I think that what we are doing in Canada is reasonably okay, given what we have to deal with. I think that if you look at countries like Australia, Japan, they did actually a very good job in maintaining the second, or basically limiting the second wave. And they're doing it just the old-fashioned way. They wear masks and they wash their hands, what we know what to do. In the US, clearly we don't see it. So the US is seeing cases rising much faster. So we are somewhere in between, as usual, between the US and some places like Japan, Australia, to an extent even Germany. We are always in between, and that's exactly what we are seeing. We are not closing down the way they did. We are not as good in practicing safe activity the way they do, but we are much better than the Americans. To me, this all is important, but the number one issue that is facing is the vaccine. And before the vaccine, I think that what people are focusing more and more in the medical establishment is rapid testing. And I'm hearing that we will have rapid testing in Canada by the beginning of the year. It will not be perfect, but it will be about 15 minutes available. And I think that's something that can really be a game changer because for the first time, we will not feel totally unable to deal or helpless when it comes to the virus. So this is the first breakaway, I think, from the current environment in which we can actually do something about the virus. So rapid testing will come before a vaccine, and I think everybody will benefit from that.
Thank you, Ben, and thank you, Kiki. Before we get to the draw I'd like once again to thank all of our sponsors. We're coming to the end of season 1, and I say that in that we are actually planning a season 2 of the CIBC PMA Summit Series, so look out for that. But one interesting thing that we have done, we've made the decision to add an additional segment on October the 29th, so mark your calendars. We are going to be discussing women in the industry. We're assembling an amazing panel of people and professionals from all aspects, different tenures within our industry and different job functions. So it's going to be a very interesting conversation. So I hope to see you there on October the 29th. And again, thank you to CIBC, our title sponsor of the entire series. I can't thank you enough for your support to help us make this happen. Our first winner is Zachary from Diamond Core. So look out for an email, Zachary. And our second winner is Joanna, and I'm going to not pronounce your name properly, Leonti. So Joanna and Zachary are our winners of today's lunch. Look out for an email with that information in the next short while. Thank you again, Kiki and Ben, for your time this afternoon. Have a great afternoon, everyone, and thank you for joining us.
Bye-bye. Thank you.